Earnings season may be nearing a close, but some of the biggest movers on Wall Street just hit the tape. We heard from Dick's Sporting Goods, Macy's, Peloton, Zoom, and of course, Nvidia. Here's a look back at some of the numbers and insight on how they should impact your investment decisions.
Dick's Sporting Goods shares, they are plunging today after the retailer saw a 23% drop in profit, lowered its guidance due to an increase in theft, which the company's CEO called an increasingly serious issue. Adrian Yee, Barclays consumer discretionary analyst, joins us now. I have a hard time believing that anybody's sneaking tailor-made drivers out of Golf Galaxy, Adrian, but perhaps Dick's knows something that I do not. Take us through your read on this quarter.
So the read on the quarter is that demand is still there, right? They came in at 3.22 billion. The consensus was 3.24 billion. The composition of that, they actually missed the comp. So the comp came in a little bit light, and it was, it was 1.7%, and it was entirely and then some driven by transactions, right? So transaction count, which is great, was up 2.8%. That then implies, right, that average unit retail was actually down. So during the quarter, we love to look at promos, and they were very promotional, which is very similar to what we've been seeing for the past 3 or 4 consecutive quarters. And at the end of the day, they're in an investment cycle. So what do we always say about when sales are going out? It's really hard to be very, very long and aggressively long, sort of companies that are going into an investment cycle, that have been doing well, that are kind of counter to the trend, and that people are already long. The trifecta.
Adrian, it's Julie here. So where are we then in that investment cycle? In other words, when's it going to start paying off in a bigger way?
We're in the earlier stages of it, of a multi-year. So they opened 7 House of Sports, and that is the banner that is sort of the experiential banner. It is the direction of travel of the consumer, right? So kind of getting away from just a place to shop, to a place to experience, search, find, and actually play sports, right, in these House of Sports in some regard. And so that is the right direction of travel. They expect to open over a period of multi-year period, 75 to 100 of these stores. But in the meantime, right, we always talk about early non-comp sales. You don't get the full kind of sales productivity out of that box until they mature over a couple of years. This is the right thing to do. When companies have excess margin and have been doing well, you absolutely want to see them go into investment phase. But it's a painful part of the cycle until you get to the harvest phase.
Adrian, some of the interesting things we've been watching over the past 2 years especially, and some of it driven by the pandemic, is the types of sports that people are playing and the new sports that have come about. I mean, we've seen the game of golf grow. We've seen, and as people are looking to get more into outdoor activities, we've seen games like pickleball just absolutely skyrocket in terms of fanfare. And then you could add on kind of an assorted realm of other sports as well that Dick's would be able to capitalize on. But if that starts to normalize in terms of the growth, what does that mean for Dick's?
I think it's okay because the athletic sporting arena, as you just mentioned, right, during COVID, you had a lot more participants, not only in the adult, millennial, Gen Z, but a lot more participants in the early stages, younger kids entering a more healthy lifestyle. This is a generational trend. So the secular growth of sporting goods, athletics, that is definitely stronger post-COVID than it was pre-COVID. I would also say that even if that normalizes, right, during the kind of period, unfortunately, of COVID, Dick's is one of the, if not the only last standing national sporting goods retailers. Everybody else is sort of regional, and there are a lot of mom and pops and independents that did not make it through this period. So to the extent that they are sort of the 800-pound gorilla in this space and the best execution, right, of this kind of sporting goods play in a secular growth, that's all good for the long term. It just, in this kind of like margin, kind of profit reset, right, you got to take a little bit off of these peak margins that they benefited from in this cycle, take it a step back, normalize it, and then rebase, and then grow from there.
Adrian, it seems to me opening these new concepts is going to require some more experienced staff as well. And just on a personal anecdotal basis, when I go into a Dick's, there are not enough people in that store. And I wonder how they're doing. You mentioned there's not another national chain that's really comparable, but I do think of the likes of an REI. Yes, it leans more outdoors. But if I go into an REI, I know I'm going to be able to talk to somebody who knows the product very well. I don't have that same assurance from a Dick's. Is there a market share situation happening there at all? Or do you think of REI sort of in a different category?
So, Julie, what I would say there is, if you think about a pyramid structure, right, and you think about kind of broad and shallow, sort of, which would be more, and a lot of expertise, a lot of customer handholding, right? That's really on the REI side of things. And then as you kind of widen out that base, right, kind of the volume drivers, right, sort of more to the masses, that's what I think of more sort of as Dick's Sporting Goods. And so I think they play in different parts of the competitive structure. Bear in mind, REI is also a private company, so we can't see exactly what's going on there. But I too agree with you. When you want that expertise and you want to buy that perfect pair of hiking boots for that, Mount Everest climb, you're going to the professionals, right? And that's sort of REI. And so I think of it a little bit kind of as two different market segments. REI plays in a smaller segment, Dick's in the bigger segment and more mass oriented. Doesn't necessarily mean there's not overlap, but I do agree with you about the kind of the customer experience. It's a big store. There's a lot of things in there. And I think you're right that, there could be a little bit more investment in payroll over time.
Adrienne, you've got a lot of people who are watching right now, taking a look at these charts, seeing Dick's Sporting Goods shares now in negative territory for year to date because of today's move here. When you think about whether or not investors who are thinking about whether or not they should be buying this Dick's dip in this stock right now, what word of advice would you give them?
I would say just take a pause. Their inventory is clean, so their inventory is very clean. Sometimes clean inventory prevents acceleration of sales because there's not as much to sell in terms of units. We upgraded the sector about a couple of weeks ago, and our upgrade was placed on the beta trade, the ones who are sitting on the low margins, not the high margins. And so if I'm recommending and advising people on how to play the consumer discretionary space in 2024, because we know that there's pain going on from all these Fed hikes and inflation, that will persist all the way through the back half, right? This critical sales season. So the real clean year to own this is 2024. And we would really kind of go more toward those who are sitting on low margins, perhaps a GPS, a Gap, which we will find out, perhaps an American Eagle. Tonight, we're going to hear from Urban, great checks at Urban. So we think Urban's a place, URBN's another place to kind of, you want to place money right now for the back half. Those are the types of names. And for sure, the off-pricers, TJX, Ross, Burlington.
Very interesting stuff. Room for upside, I guess, is what people need to focus on. Adrienne Yee, Barclays Consumer Discretionary Analyst. Thanks so much. It's always great to talk to you.
Great to talk to you.
Take care,
Thanks
Adrienne.
for having me.
Earnings from Lowe's this morning coming in a little more optimistic than its competitor Home Depot's results last week. Lowe's comparable sales down a little less than expected at 1.6%. Meanwhile, Home Depot's were down 2%. So what do these results really say about the housing market? Joining us now, we've got Cole Smead, Smead Capital Management CEO. Cole, great to have you here with us this morning. So perhaps we could start off with that question. What does this say about the broader housing market, given that you've got two of the larger DIY plus some of those larger business-to-business contracts and purchasers that take place for both of these companies?
Yeah, so we've owned Home Depot for years. We think housing has been probably the most misunderstood part of the economy looking back over the last 10 years. No one thought we'd be where we're at on housing, where tight supply, even though affordability is terrible right now relative to the last decade, is causing housing to be strong. I think what Home Depot and Lowe's have had to deal with is, as interest rates have increased, it just marginally caused people to look less to a home equity line to revamp their home and do things of that nature. That's a bigger component of their life versus just housing supply itself is really more to do with the home builders. So I do think the one tailwind that Lowe's and Home Depot have and will continue to have for many years to come is we've busted one of the great myths of all time, which was that millennials were never going to buy houses. And now that they own them, that's such a huge customer base to those retailers. And that those DIY companies like Home Depot and Lowe's, I think, have really good secular trends in their favor.
At the same time, housing is getting less affordable, right? In part because of what's going on with interest rates. In part, we're just not seeing much movement within the existing home sales market because people don't want to sell to pay those rates. So are we going to have a period of more stagnation that's going to continue?
Well, to your point on supply, it's such a healthy environment. In other words, why are high rates not, causing housing to fall apart? Because there's no available homes for purchase. What are some other myths that were out there on housing? Baby boomers were going to move out of their houses and go into assisted living earlier on. That never happened. COVID proved that won't happen. They'll live in their houses till they're 90, which would be a shock to what people thought 10 years ago. So I think there's other trends that are going on in housing that are really causing that tightness. But again, unless you have the higher income from a new job or you're getting paid better to move to a new area, you aren't going to leave your 3% mortgage, 4% mortgage, et cetera. It's only based on income will someone do a move up trade or just a pure need and they have the equity to do it. That's a very healthy housing market. Go back to 2007. You'll find we had the largest supply of homes available for sale that we've ever had. Which housing market would you want to be in? The one that's going to be a nightmare for years, or tight supply that looks like it's going to be a bull market for quite a long time? By the way, housing's the only good game in real estate, just so we're all on the same page. It's the only game in town doing well.
And so with what you're seeing in housing at this point in time, and I'll give you some anecdotal evidence. I went back home to Pennsylvania, at least where I grew up, and there's an entirely new kind of just residential community being built up where there used to be cornfields. And we're seeing that in several states. This is just kind of one example. And I have no doubt in Arizona, perhaps not cornfields being transitioned, but some other area where it was wide, vast, open, where new developments are popping up. And it seems like much of that could be driven by a few things in each of those markets. And all of this to say, are you seeing more perhaps new first-time home buyers saying, you know what, we'll just try and get a new home versus purchasing an existing home and then doing a bunch of the DIY renovations? What does that tell us about the housing market?
Well, there are no homes for sale. So it has to come from new supply ultimately, because someone's got to move to that new supply to make, the existing homes, up for sale. So I think, again, new supply will tell us what's going to happen in housing, whether you're Home Depot or Lowe's or whether you're Lennar and D.R. Horton. To your point, a large project out in the cornfield, to quote the Monty Python, "'tis merely a flesh wound." It's not changing supply at all. Here we are in Arizona. Water's a big deal. So you go look at municipalities like Maricopa, Arizona, Casa Grande, Arizona. You'll find that cities like that have water, they're growing rapidly. They're some of the fastest growing cities in America. If you go to other municipalities where you don't have water, you're not going to grow as much. So I think there are some, constraints in each market. Some markets, it's just available land. How costly is that land? In other places like the West, it will come down to water. But don't forget, when you turn corn farmland into housing, you actually use less water. It's one of the things I always tell people here. If we turn fields into houses, we got a lot more water here in Arizona.
When you're looking across the real estate industry and just trying to decide where to invest, as you mentioned, other parts are not doing so great, but there are parts like data centers, like warehouses, et cetera, that are doing a bit better. I mean, forget about office for a minute. Are there other areas of real estate that are interesting to you guys?
So if you look at the cap rates across the real estate space, it's gone from as good as it got at low rates to the largest rise in cap rates you'll ever see probably in your lifetime. So for example, use industrial. Industrial is trading at 4% cap rates. You're not going to find industrial trading at those cap rates. You're going to find them waking up somewhere closer to 5 or 6%. That's just tectonically different, because then someone going to develop new industrial has got to pay a premium to that because there's risk for the bank to have them build it. So I think that's really the trend you're seeing. Multifamily, I think if you go look at Howard Hughes Corp, they're trying to build apartments. They said, I think it was last quarter, they went to 49 banks looking for loans on a multifamily project. They couldn't get lending. That is very common. Banks are shutting lending down, or if they are going to provide lending, you're going to pay 10, 14, 16% construction loans. So I think that helps existing assets out there, but at the same time, it doesn't help the price of those assets. There's going to be less supply in a lot of real estate arenas, but I mean, we got to swallow kind of a pig through a python here. Commercial real estate's worth a lot less. We don't really know how bad it is. We don't really know what the reset price is. We're probably going to peak over 10% cap rates in commercial office. And then the question is, what's the good properties and what's the bad properties? I was just in Seattle 2 weeks ago. Downtown Seattle's a ghost town. relative to when I grew up in that town. That's very common in West Coast cities. It's very common in parts of the East Coast as well. So we have got to get through those problems. And I also think that will spill over into the banking space as we look forward 5 years. Not all banks will be affected by that, but it just goes to show you that we have real problems based on the price of money changing. And obviously that's what the Fed's doing on the short end of the curve.
All right, next time you're in Seattle, I need you to pick up some fish seasoning for me because I've been asking everybody that goes out to
I'll be there
some.
next week.
Yeah? Done deal. All right, I'll write it down. Just while we're on the topic, though, of housing, Cole, just to bring it to some of the current events that have taken place, too, and I think about the hurricanes here, about all of these different kind of severe storm systems that people who are purchasing a home are thinking about even more so. Is that likely to move the needle on where people are even willing to either move and start new financing on a home project, or just move the needle at all in terms of where people are deciding to take up residence?
I think the affordability land is bigger than the weather. I mean, for example, Florida has had cheap land historically. If you look back 20 years, you always paid nightmare hurricane insurance down there. It's a very expensive thing to do. And so I don't think the weather side's a very big deal. Can you get cheap land? Back to supply. That's the supply question. If you can get cheap land, you're going to find supply grow in the region. That's why you're seeing building continue to grow in the South. That's why you're seeing, building continue to grow in the Southwest, in parts of the Midwest, but you're not seeing as much on the West Coast. You're not going to see as much in the Mid-Atlantic or the Northeast. So I think we're definitely seeing a trend of people moving. And I also think the other thing you can add into that is the work from home. It's not going to be as bad as it was in the pandemic, but we're definitely not going back to 2019 work standards. I think mothers with children that work, they're the dominant force in that conversation, and they're going to dictate to America how they're going to work and when they're going to work. And I think that's really changing housing, in my opinion.
Well, as you heard there, shares of Macy's under some pressure this morning after reporting second quarter results. It beat on its top and bottom line, but investors don't seem happy. Well, our very own Brooke DePalma listened in on that earnings call and has the lowdown on what is driving the stock down this morning. Hey, Brooke.
Good morning, Rochelle. That's right. This is the largest intraday drop since June of 2022 following this earnings call with executives this morning that painted a cautious outlook on the second half of 2023. Some key takeaways from that call. We did see same-store sales decline down 7.3%. And while that was better than analysts expected, customers continue to shy away from items that they bulked up on during the pandemic. That includes activewear, casual, and sleepwear. That drove those same-store sales to continue to decline. They did say, however, that categories like beauty as well as fragrances and other high-end makeup cosmetics do continue to do well. Meanwhile, Bloomingdale's business did come in same-store sales decline there, but less than the overall same-store sales report. They said that they're really focused there on being the winning option for multi-branded upscale retail. A highlight at Bloomingdale's is their outlet locations continue to outperform. And later on this month, they're opening up their 21st outlet. Now, moving along to perhaps the biggest surprise of this report is that decline in credit card revenue. That came as one of the biggest surprises across multiple reports from analysts on the street this morning. That was down $84 million from last year. Now, the CFO rather said that they had expected delinquencies to rise, but it happened faster than they had predicted back in Q1. They also said the speed of those delinquencies across all age balances accelerated after that first quarter report, especially in June and July. Now, the CFO did add that the team is working to mitigate the impact of this with its partner at Citibank, and so perhaps that is a telling sign of something that we'll look out for in Citibank's upcoming third quarter results. And in addition to that, a bright spot of the report, they did say that one of their five growth vectors is that new smaller format that continues to outperform. They now have 10 smaller format locations, and they plan to open 4 new store locations with this smaller format later on this year. And so lots to digest in this report, but really doubling down on where the consumer is at.
So, Brooke, how does the company see macroeconomic conditions impacting the consumer?
Yeah, absolutely. Well, they did reiterate their guidance here, and they now expect net sales to be between $22.8 billion and $23.2 billion to round out the year. But the CEO telling investors on the call once again that they are taking a cautious outlook when it comes to the consumer on the back half of this year. They continue to highlight the pressures that they're seeing. They did identify who exactly their consumer is. They said that it's roughly 50% with an average household income of $75,000 and under. Now, the CFO also didn't shy away from the headwinds that the consumer is up against. Take a listen.
So the macro environment really is having the lion's share of the impact on credit and is a real indicator of where we think the health of the consumer is and supporting our cautious approach. The one metric we find quite interesting is the debt service ratio, which we leverage as a proxy for the consumer's ability to pay debt using their disposable income, personal income. So this is about credit card balances. This is about student loans, which we know is going to come into focus in the next month or two, auto loans, mortgage. So we just believe that the customer is coming under pressure because these are new realities that they have to continue to deal with as we get through the back half of this year and move into next year.
Now, this is something that we also heard from other retail brands like Target and Home Depot, all these headwinds up against the consumer. So you think about the vibe check of this call, well, not so good. It's actually pretty bad about when you think about the headwinds that the consumer is up against, when you think about those that are going to Macy's for the back to school shopping season, and when you think about that holiday season, especially they also mentioned Halloween even, rounding out, the back half of this year. There's lots of different headwinds that are impacting consumer spending that Macy's is very aware of. And so bad, but maybe it'll get better next year, Rochelle.
We'll certainly see that holiday spending season will be a key one because, as we mentioned, starting to see some cracks there for the consumer. Great stuff. Appreciate that breakdown for us, our very own Brooke DePalma.
Nvidia out with its second quarter results, and look at that. We're looking at gains of just about 6.5% here in extended trading. Another huge report here from the chip maker. A lot of this gain that we're seeing in after hours is because of that massive forecast that they're giving here for third quarter revenue, 16 billion plus or minus 2%. The estimate was for 12.5 billion. We take a look at the numbers for its second quarter revenue coming in better than expected, 13.5 billion. The estimate was for just over 11 billion. That's up 101% on a year-over-year basis. Record data center revenue of 10.32 billion. The estimate was for 7.98 billion. That's up 171% from a year ago. Gaming revenue, 2.5 billion, beating the street's expectations. Adjusted EPS also coming in better than expected, $2.70. Nvidia also approving an additional 25 billion in share buybacks. Let's break it all down. For that, we want to bring in Angelo Zeno, CFRA Research Senior Equity Analyst. Angelo, good to see you here. An extremely strong report from Nvidia. What do you think of it? Your first take?
No, it was fantastic. I mean, clearly as far as the quarter is concerned, it was all about the data center side of things. You kind of broke down the numbers extremely well, and you kind of look at where data center landed at about 10.3 billion. That compares to about 4.3 billion just in the prior quarter. And, to your point, it grew north of 170%. Our view was it would come in at around 8 billion. So, north of 25% higher than what we anticipated on that side of things. I think also, on the gaming side of things, it also looked really good. Grew about 22% year over year. We were looking for growth of about 15%. That was the first quarter gaming actually saw growth in 5 quarters. So it was good to see kind of a return to year over year growth on that side of things, clearly due to some easy comps on that side. And then, of course, in terms of the guidance, I mean, absolutely fantastic. Looking at a $16 billion run rate now, you're talking about a company that's now annualized kind of running at a revenue clip of north of 60 billion, right? So it's just absolutely astonishing how quickly the revenue trajectory of this company has grown here over the last 2 to 3 quarters.
So, Angelo, when you think about Nvidia, it's kind of like I keep thinking kind of these Olympic analogy. It's like the Usain Bolt in this space. You've had a $500 price target on this. It's clearly going to eclipse that based on where it is in after hours trading. How much further do you see this stock running?
I think that's a good question. I mean, I think kind of what everyone's kind of thinking about these days is, Nvidia is clearly kind of entrenched in a highly cyclical industry. I will say this, there are parts of Nvidia's kind of guidance and revenue trajectory right now that is cyclically oriented, and then there are parts that are where you've kind of got a real structural shift and change taking place. And just kind of looking in terms of their GPU business, right? I mean, you look at an AI server today, you've got about 8 GPU sockets that you can kind of attach to an AI server, whereas some of those traditional servers, you're talking about 2 GPUs. So their addressable market is really growing exponentially here, not only here in 2023, but over the next couple of years. We think that trend will continue as a bigger percentage of the server market becomes AI driven in nature. We've kind of seen some of the forecasts that have been driven out there by the likes of Lisa Su and Jensen Huang in terms of how big the accelerator market can be, which is really kind of the key kind of driver here on the as we kind of shift towards this more AI enabled market. And our view is this grows from a mid-30s revenue run rate in terms of accelerators to one that's going to grow north of 130 billion by 2026, 2027. So we think there's kind of real runway here to continue, not only into 2024, but even beyond there.
Angela, massive runway for growth, but one of the limits and one of the things that we've been talking about over the last couple of weeks that's been brought up a number of times by analysts has been this expectation or question about whether or not Nvidia is going to be able to have enough supply to meet that demand. Is that an issue? How big of a realistic issue do you see that being? Because it doesn't
well, I mean, given some of the guidance, yeah, you look at the guidance out there, right? I mean, it definitely seems like in Taiwan Semi out there, it's throwing some preferential treatment out there to Nvidia. So as far as kind of being able to kind of get access to that supply, it doesn't seem like it's an enormous issue here right now. We do think that demand continues to outstrip supply, so their numbers could probably be even better than some of the numbers they are guiding to. But that's a great problem to have if you're Nvidia, and in many respects, it's probably a good problem to have because you don't want to overheat in this market, right? The fear clearly is on the double ordering side of things, but when you kind of think about some of the big cloud providers out there and what they need to do to kind of upgrade their infrastructure. Again, this isn't going to be a 1 or 2 quarter thing. This is going to be a multi-year process in terms of our view. So it is somewhat supply constrained, but we don't think it's much of an issue when you kind of look at the guidance that they've been given out there.
And so to your point about Jensen Huang talking about just this transition that companies are making, he said in the earnings report, quote, a new computing era has begun. Companies worldwide are transitioning from general purpose to accelerated computing and generative AI. So when you think about Nvidia and you kind of draw parallels to, say, the .com era and, who the leaders were then, who would you liken Nvidia to, and how long do we think this runway is going to last, especially when we're starting to see a little bit of cracks when it comes to kind of some economic headwinds happening?
Yeah, so when I think of an Nvidia, I actually compare them more along the likes of some of the bigger trillion-dollar companies you have out there, whether it be kind of an Apple and what they've done to the mobility era, what Amazon has kind of done to the e-commerce kind of era out there. And we have previously stated that Nvidia probably going to be the most important company to civilization here, we think, over the next 5 to 10 years. Not necessarily the biggest market cap company, but the most important one out there, because they are going to drive essentially every single enterprise company out there on the planet, whether directly or indirectly, will be exposed to Nvidia here over the next 5 to 10 years, and will significantly rely on Nvidia to an extent. So to that extent, we would kind of compare them to the likes of an Apple, and Amazon, maybe and Netflix to what they've done on the streaming side of things. So that's how I would kind of compare Nvidia relative to some others out there.
Angela, do you see anything stopping this massive boom in spending that we've seen in AI and the hype around it, Nvidia being the leader, and the fact that, given the forecast, they're not seeing it slow down anytime soon?
Yeah, listen, I think as far as kind of the risk out there for Nvidia, competitive pressures are not something that we think is a major risk out there. Clearly, AMD is coming out with their kind of offering out there, and we do love kind of what AMD has the potential to do in 2024 and beyond with their MI300 chip that's going to roll out here over the next couple of quarters. Intel's got some potential out there, but nothing we're concerned about as far as kind of the Nvidia story is concerned. But clearly there is a cyclical risk that you always have to take into account here. There is kind of uncertainty on the China side of things. Is there some sort of ban that's on the horizon that could have a bigger impact to Nvidia's business over time? That does kind of have a potential impact to the addressable market out there for Nvidia. And then also, as things eventually start to kind of level off here, is there some sort of pricing risk out there in terms of their business? Clearly, they are pricing their GPUs at a significant premium right now. So there is going to be at some point some sort of downdraft for Nvidia, given some of the cyclical nature of this business. But that said, if you are a true long-term investor, kind of looking out over the next 3 to 5 years, we think there is considerable upside to the revenue trajectory of this company.
All right, Angelo Zeno, great to get your perspective. CFRA Research Senior Equity Analyst. Thanks.
Thanks, Em.
Big quarter out of Abercrombie & Fitch. I want to get right to really, I would say, the story of the day. That is with Fran Horowitz, the CEO of Abercrombie & Fitch. Fran, always great to get some time with you. I got this question from the Yahoo Finance community this morning. How did Abercrombie & Fitch put up this quarter? I'll put that question to you. How'd you do it?
Hey, Brian, thanks. Great to be here. So, it's interesting if you just take a step back a little bit. We have been seeing some nice progress in our business, particularly in the Abercrombie adult brands. It's our 10th consecutive quarter of growth. What we were excited to share, too, is that we saw now an inflection in Hollister and saw that coming back to growth. So the story behind the story is years of hard work, lots of transformation in the company. We've really top down and bottom up gone through every single function. We have something that we refer to as our playbook. And that's getting our product and our voice and our experience aligned for the consumer by listening to them, talking to them, going through customer insights. And that is really what we were very excited for the team to do extremely well this quarter and continue to do so. The other piece, which I know we've talked about a bit, is Chase. So the fact that we have Chase back in our business and the supply chain has eased up a bit is a big, big win for us. That's a big tool in our toolbox.
I'm not going to ask you, Fran, to critique your competitors in the mall. I'm not going to do that. But look, Foot Locker, tough quarter. Dick's Sporting Goods, tough quarter. These companies in some way are attached to the mall. Where you are, what is it about your customer base? Why are they opting for what you're selling in a very challenged consumer spending backdrop?
Yeah, my answer to that, Brian, honestly, is that in any economic cycle, there are winners and there are losers, and we are winning because we are getting our product, our voice, and our experience aligned, and they're responding to it. So the opportunity is to continue to stay close to that customer and make sure you're providing for them what they're looking for. You know, last Q2 in Hollister, we had a tougher time, and we stepped back and we said, how much is macro and how much do we own? And we worked on the part that we owned, and that was about our assortments and evolving them, being more than denim for back to school. What else were they looking for? Dresses. What were the wearing occasions for these kids? And that's the piece where you really just have to spend a lot of time, whether it's on social platforms, whether it's in your stores, talking to your consumers and getting those insights.
Who is coming into these stores? And let's start with the Abercrombie & Fitch brand, Fran, because it doesn't look like they're walking into Dick's Sporting Goods to buy athletic apparel. Doesn't look like they're going out necessarily and buying sneakers at Foot Locker. Macy's challenge quarter. What is that? Who is coming into Abercrombie? Is it 20 to 30-year-olds with maybe a little more money in their pocket than people think?
Yeah, I mean, the transformation of the brand, which you've been on that journey with me for quite some time, is that we've really aged up the brand. So I would say that the target, when we target a consumer from our marketing and our design perspective and our merchants is a young millennial, so mid to late 20s. But the exciting thing about the brand is now it is such a broader range of people that are responding to it. So perhaps they start shopping with us in their 20s, they're still here in their 30s and in their 40s. So we're seeing both a broadening of categories as well as a broadening of age visiting the brand.
How are they shopping once in the Abercrombie & Fitch store? Fran, is it more casual, back to college? Is it where to office, where to work? Where are you seeing some disparities?
We're actually seeing a little bit of both. So yes, to your point, when people talk about back to school, for the Abercrombie brand, it is back to college because that's really when they start to shop with us. But we're also seeing all of the return to office. We're seeing the consumer needing a very balanced wardrobe today, Brian. They need clothes for when they are working from home, and they need clothes when they're going to the office. The exciting thing about the Abercrombie adult brand, though, is that even if they buy something from us to go to the office, they can transition that and they can go from work to weekend and to their getaways. They buy our Sloan Pant Women's, which is one of our biggest franchises today. She can wear that one way to go to the office, and then she changes her, whether it's her top or her shoes, and she goes out right after work, or she packs it up for the weekend. So it's very, very versatile.
I promise I will get to Hollister, but still on Abercrombie & Fitch, what does the cadence of this business look like for the rest of back to school? Are you seeing a good start here in August into September? And then what are some of your big bets for the holidays for Abercrombie & Fitch?
Yeah, so specifically, as you've mentioned, not a back to school brand. So we see a much more consistent business with Abercrombie than we do with Hollister. Hollister, you'll see some bigger spikes in the business with the actual back to school timing. Our expectation for holiday is that we're going in with momentum. We're going to continue to read and react to our business. As you saw today, we raised our outlook for the back half, and we're excited to have the momentum heading into the back half.
What about Hollister? So this is a more, I would say, economically challenged sector. We heard, I think, some cautious comments from Urban Outfitters when they reported. In many cases, you're operating close by in the same mall. What is the Hollister consumer doing?
Yeah, so I would say the teen consumer is definitely more pressured. That's what we started to see, last year and still seeing it today. But the consumer is shopping, and they're going to continue to shop. They're just making choices on who they're shopping with, and they're choosing our brand because we've really worked hard on evolving our assortments, staying close, understanding what those trends are for back to school. I visit stores quite often. I was in Texas for back to school a couple of weeks ago, and the energy and the excitement in the mall and in our stores was really, really exciting.
Has Hollister fully turned the corner?
I don't think there's ever a finish line. What I would tell you about this teen consumer, Brian, is they keep you on your toes. They are ever evolving. You've got to stay very close because, with TikTok and all the other things that are showing them fashion and all these trends so quickly, there really is no finish line. You've really got to continue to evolve.
Is it fair to say that in Abercrombie and Hollister, that those sales are being driven by the female business?
No, in fact, what you'll see happening, so In Abercrombie women's, the turn did start in women's because women do shop more frequently, and we had an opportunity to speak to them and get them interested. And now our men's business is really strong. We saw double-digit increases. I think it's our third or fourth quarter of sales growth for Abercrombie men's. So we're seeing a lot of exciting things happening in that business. In Hollister, our girls' business was better than our guys' business, but our playbook will show you that it turns first in girls, and our expectation is that guys will follow.
How concerned are you about student loan repayments? We have a piece on the Yahoo Finance homepage today. A lot of retailers are calling out that as a risk to their business for the third quarter and maybe the holiday season. How do you see it within Abercrombie & Fitch?
You know, if you've sat in this seat for the past few years, we're ready to manage anything that comes our way. I think the fact that our inventories are so lean and we're controlling what we can control, if things do happen and their consumer becomes more pressured, the best way to be is very lean in your inventories.
But you didn't factor that into your guidance. To your point, you raised guidance. You're still looking for maybe your consumer to overcome any student loan repayments. Is that right?
100%. That's exactly goes back to what I said earlier, which is that the consumer has a choice of where they're shopping. They will continue to shop, and they are choosing us because we're putting out the right brand, voice, and experience.
Do you have enough inventory? Your inventory was down 30%. Is it down in Hollister and Abercrombie & Fitch? Those are big declines. If you're seeing sales up over 20+% in Abercrombie, do you have enough stuff on the floor?
We do. And yes, specifically, our inventory is down more significantly in Hollister than it is in Abercrombie because obviously that trend was going a lot sooner than the Hollister trend was going. We have an incredible sourcing and supply chain, Brian. And now that the woes of 22 are behind us and all of those logistical issues are behind us, we are back to chasing. The team comes in on Monday morning and they're able to react to their business, and we're able to turn it very, very quickly. So for us, that was a big hurt for last year, and it's a big win for us this year.
Has inflation stopped being a major problem for your business, and how do you see that playing out?
No, we're definitely still seeing inflation in the business. It's obviously subsiding a bit. Where we're really benefiting is this, again, with the supply chain and the cost of the freight going back to much more normalized rates has also been very, very helpful.
I was scrolling through your investor presentation. My old analyst self stumbled upon this. So your targets for 2025, 8 to 10% operating margin, right? This year you might be close to 10. Do you have to take those targets up?
Yeah, so that comes from our investor day that we had last June. And, when we had that day, it was pretty gutsy to do it when there was a lot of turmoil happening all around us, but it was important for us to get out there. We're not really talking about 24 and 25 yet, but certainly if the year comes in as we have projected in our outlook, we would expect to revisit those.
Lastly, Fran, 60 days ago, did you think you'd be reporting a quarter like this and actually raising guidance? To my knowledge, over the past 2 weeks, you were really the only retailer that has come out here and raised guidance.
Yes. I think that the years of this hard work and the transformation is certainly paying off, and staying close to this customer is a big win. Today on campus, honestly, Brian, it's such an amazing day for the teams to see all their hard work coming to fruition.
Fran Horowitz, I don't know how you do it, but you did it this quarter, and look forward to continuing to following your journey over to Abercrombie & Fitch. Always good to see you. Appreciate it.
Yes, you as well. Thanks, Brian. I appreciate it.
Shares of Nvidia are on the up after smashing estimates in yesterday's stellar earnings report. They're up about 6.5%. The chipmaker flexing booming demand from AI intelligence computing. Its data center business was the star of the show. It rose 141% from the previous quarter. The stock's stellar run was enough to convert some skeptics. Morningstar, the last remaining firm with the equivalent of a sell rating, finally upgraded Nvidia to fair value. Stifel analyst Ruben Roy also upgraded Nvidia to buy from hold after yesterday's report, and he is joining us now. Ruben, I know that you are getting more optimistic or more positive on Nvidia here, but I want to start kind of from the other side of the equation. Nvidia seems to be killing it from every potential angle. What could go wrong here? Was there anything in the report that gives you pause at all?
It's a great question, and thanks for having me, Julie. It's one of the things where the guidance and the outlooks have been increasingly strong, and we thought, gosh, when we had the earnings report in May and the July quarter guide of $11 billion, it's probably not going to get much better than that. And there were three areas that we were thinking about. Supply, right? There's supply constraints throughout the semiconductor channel, and we thought potentially there'd be some supply impact near term. China, expanded restrictions on technology sales into China. And then the third was just kind of after a massive CapEx investment cycle, there typically are periods of digestion. So you think about those three things. Well, guess what? Nvidia talked about all three and essentially took away all of our concerns on the conference call last night. So starting with supply, Nvidia is doing a lot of work with their supply chain partners. They've qualified additional supply chain partners, and they've got supply set to increase every quarter through the entirety of next year. China, Nvidia clearly stated that expanded restrictions and regulations will not have any impact on near-term financial results. And then the third, which is really important, the digestion period potential. Nvidia very clearly there too said that they have visibility at least into 2024, and it sounds like 9 months of visibility into demand for these chips and systems. So really nothing to pick at on the call last night.
Okay, so with all of that considered, I mean, so much focus on the data center side and what artificial intelligence can do for that business, but also what about what we all said was the core business for this company prior to the AI hype phase in the GPUs, in the graphics processing units?
Right. So gaming, Brad, used to be 65% of this company's revenue. Guess what? Data center segment was 76% in the quarter reported last night. So, clearly a shift into where the investment dollars are going for Nvidia. And I'd say one of the things that we underestimated was the fact that it's really a generational compute shift. It's not just generative AI that's driving the demand for Nvidia chips. It's this concept of moving away from x86 general purpose processing servers to servers that are based more on Nvidia GPUs and less on x86 chips. The reason for that is that it's a more efficient way of processing the workloads that today's data centers need to process, and generative AI is actually accelerating that move. So you've got $1 trillion, Jensen Huang, the CEO of Nvidia, talked about in installed data center infrastructure globally. And gradually, that infrastructure is going to transition to the type of compute that Nvidia is doing. So gaming is still important, $2.5 billion or so quarterly revenue I just reported, and it's still a growth area for the company. But certainly when we look at these data center numbers, that's where the action is. We're actually forecasting now data center revenues to increase to $60 billion next year.
Wow. Ruben, one of the other risks that you did mention briefly, China, I wanted to dig into that a little bit. Now, Nvidia for now seems to have loopholed it, right, and to have developed chips that are still passing muster from the Biden administration to be sold into China. That could, of course, in theory, change, and CFO Colette Kress warned about the ramifications of that on the call last night. How are you sort of gaming out that likelihood of whether indeed we could see more stringent regulations?
We could. It's a little bit of a tough one to call right now because we really don't know how far the U.S. government is going to go on restrictions. I would say that thinking about China as a percentage of overall revenue for Nvidia, Colette also talked about China being 20 to 25% of the data center segment. So kind of on trend historically. There were some concerns that, hey, are we getting some pull-ins on orders in China because of fears of additional export restrictions? Doesn't seem like that's going on right now. I'd say bigger picture, and this is not really long term, but certainly, what I talked about with visibility into 2024, the way I'm thinking about it is 12 to 24 months worth of demand is out there. Nvidia's been allocating GPUs and it's global. It's the UK government, like we heard recently in some news, the Saudi Arabian government, it's cloud service providers globally, ex-China and in China. So there's a lot of demand out there and somewhat limited supply still. So we'll see what happens, but for right now, it doesn't seem like it's going to be a big issue for the company.
Just lastly, while we have you here, Ruben, as well, when we think about the price point and that strategy moving forward from here, is there going to be any kind of tail effect to that pricing where you've got some of those early purchasers, early orders that have come in for NVIDIA, and especially within that DGX cloud But then additionally, how does that need to kind of change over time in order to kind of trickle down to other parts of the potential portfolio client base that they either already do have and they're trying to upsell, or net new clients that they're trying to bring on?
Sure. Right now, Nvidia is enjoying a dominant position, enjoying pricing as such, right? So there are competitors coming in. He's got a competitive platform that's going to start shipping in volume later this year. And it's certainly a lot of companies are trying to figure out alternatives to Nvidia, given what you just talked about. I mean, these are expensive platforms and chips. You know, the good news for Nvidia, and there were too many questions on this on the call last night, but gross margins are increasing quite materially. The guidance for October quarter calls for 72.5% gross margin, and that's a combination of data center mix moving up, as well as software becoming a more important part of the sale. This is an ecosystem that Nvidia is selling: hardware, software, networking, and we think, yes, ASPs certainly over time are going to come down, but as that software component of the sell increases, and it's really early days for that, that's going to drive overall profitability up for the company. And we think that's going to be a very interesting driver in terms of multiple expansion from a longer term perspective.
Ruben Roy, Stifel Applied Technology Analyst. Thanks so much for taking the time here this morning to kick off our NVIDIA discussion. Ruben, appreciate it.